$17.9 trillion. That's how much money sits in U.S. banks right now. And here's what should terrify you. $9.2 trillion of that is completely uninsured. No FDIC protection, no government guarantee. Just sitting there, vulnerable. The banks know it, the Fed knows it, and they're not telling you. Because what's coming in 2026 isn't just another financial crisis, it's the complete restructuring of American banking, and your savings account is ground zero. Let me show you exactly what they're hiding.
Right now, financial experts are saying everything is fine. Jerome Powell says the banking system is resilient. Yellen says deposits are safe. CNBC runs headlines about economic strength. Bloomberg talks about a soft landing. The Wall Street Journal predicts continued growth. These are the same people who said Bear Stearns was fine in March 2008. The same experts who said Lehman was an isolated incident. The same institutions that had buy ratings on Silicon Valley Bank the week before it collapsed. Do you see the pattern? They're always wrong at the turning points, not because they're stupid, but because they can't tell you the truth. The truth would cause the very crisis they're trying to prevent. So they lie, they smile, they say resilient, while behind closed doors, they're preparing for what's coming.
Let me show you three forces converging in 2026. Each one is dangerous alone. Together, they create a perfect storm that breaks the banking system. Convergence 1, the unrealized losses time bomb. $684 billion. That's the total unrealized losses sitting on bank balance sheets right now, according to the FDIC's own data. Here's what that means in English. Banks bought treasury bonds and mortgage-backed securities when interest rates were near zero. Those bonds paid 1%, 2%, maybe 3%. Then the Fed raised rates to over 5%. When rates go up, bond prices go down. It's simple math. A bond paying 2% is worthless when new bonds pay 5%. So banks are sitting on bonds worth far less than what they paid. These losses are unrealized because banks haven't sold yet. But here's the trap. The moment depositors get scared and withdraw money, banks have to sell those bonds. The moment they sell, unrealized losses become real losses. Real losses destroy capital. When capital is destroyed, banks fail. Silicon Valley Bank had $16 billion in unrealized losses. Depositors panicked. The bank sold bonds to raise cash. Losses became real. Bank failed. 48 hours from stable to dead. Now multiply that by $684 billion across the entire system. That's not one Silicon Valley bank. That's 40 Silicon Valley banks waiting to happen. Convergence 2, the commercial real estate avalanche. $2.8 trillion, total commercial real estate loans held by U.S. banks. $1.5 trillion of that debt matures between 2024 and 2026. Already $929 billion matured in 2024 and 2025. Another $570 billion matures in 2026 alone. Here's the nightmare scenario. An office building in downtown anywhere. Financed in 2019 at 3.5% interest. Loan matures in 2026. Building is now 35% vacant because remote work. Revenue is down 40%. Property value dropped 30%. The owner goes to refinance. New rate is 7.5%. That doubles the mortgage payment on a building worth 30% less, generating 40% less income. What does the owner do? They walk away. They hand the keys to the bank. The bank takes a loss. One building, one loss, manageable. But it's not one building. It's happening across thousands of properties simultaneously. Regional banks hold 70% of all commercial real estate debt. These aren't J.P. Morgan and Bank of America. These are the banks in your town, the ones with 10, 20, 50 branches, the ones your business uses. When commercial real estate losses hit, these banks absorb the damage. Their capital gets wiped out. And unlike 2008, there's no political will to bail them out.
Convergence 3, the deposit flight acceleration. Money moves at the speed of light now. In 1929, it took weeks for a bank run. People had to physically line up. In 2008, it took days. In 2023, Silicon Valley Bank collapsed in 48 hours. All digital, all through phones. Depositors just clicked transfer. The entire $42 billion vanished in 2 days. Here's what's different now. People learned. They watched Silicon Valley Bank. They watched Signature Bank. They watched First Republic. They learned that uninsured deposits above $250,000 can disappear, and they're not waiting around to see if it happens again. Look at the data. In Q1 2023, deposits fled regional banks at record pace. $472 billion moved from small banks to big banks in just 6 weeks. Why? Because people assume big banks are too big to fail. They assume the government will save J.P. Morgan, but not First National Bank of anywhere. They're right. So money is concentrating in the largest institutions. Regional banks are bleeding deposits, and bleeding deposits means they have to sell assets. Selling assets means realizing those $684 billion in losses. Realizing losses means failure. The cycle feeds itself. The feedback loop of doom. Now, let me show you how these 3 convergences connect, because separately, any one could be contained. Together, they amplify each other into systemic collapse. It starts with commercial real estate. A major landlord defaults on a $500 million loan. Regional bank takes a $200 million loss. News spreads. Depositors see the headline. They check their balances. $80 million in accounts over the FDIC limit. They transfer to J.P. Morgan overnight. Now the regional bank has a deposit crisis. To cover withdrawals, they sell treasury bonds. Those bonds have unrealized losses. Selling them makes the losses real. More capital is destroyed. More headlines. More deposit flight. The cycle accelerates. Other banks see this happening. They tighten lending standards. If they're losing deposits, they can't make new loans. Businesses can't borrow. Commercial real estate owners can't refinance. More defaults, more bank losses. The contagion spreads. This isn't theory. This is exactly what happened in 2023. But 2023 was contained because the Fed stepped in. They created the Bank Term Funding Program. They backstopped deposits. They prevented total collapse. Here's the problem. That program expired in March 2024. The Fed used its emergency powers. Those powers are now exhausted. The political environment is different. There's no appetite for bailouts. The tools that worked in 2023 won't be available in 2026.
Let me show you the specific dates that matter. March 2026. That's when the next wave of commercial real estate debt matures. $197 billion in office loans specifically. Most of these were originated in 2019 and 2020, 7-year terms, coming due right now. June 2026, regional bank earnings season. If commercial real estate loss is accelerating, it shows up here. Analysts downgrade, stock prices fall, depositor confidence cracks. September 2026. Historically, September is when financial crises peak. 1929 Black Tuesday was in October. 2008 Lehman fell in September. There's something about autumn and financial panic. Maybe it's back-to-school psychology. Maybe it's the end of summer optimism. Maybe it's pure coincidence. But the pattern repeats. If 2026 has a breaking point, September is when the dam cracks. Quarter 4 2026. This is when the political pressure becomes unbearable. Banks will be begging for help. Congress will be deadlocked. The Fed will be out of tools, and your deposits will be caught in the middle. Destroying the objections. Now, let me kill the arguments you're already forming. Objection 1. The FDIC protects my money. The FDIC has $128 billion in its insurance fund. Total insured deposits are $10.5 trillion. That's 1.2% coverage. If even 2% of insured deposits are at failed banks, the FDIC is broke. In 2008, the FDIC fund nearly went to zero. They had to issue debt to cover bank failures, and 2008 was smaller than what's coming. The FDIC works when one or two banks fail. It doesn't work when the system fails. Objection 2. Big banks are safe. JP Morgan has $3.7 trillion in assets, $2.4 trillion in deposits. If just 10% of depositors panic, that's $240 billion in withdrawals. No bank can handle that, not even JP Morgan. They'd have to sell assets that have unrealized losses. Even the giants are vulnerable.
Objection 3. The government will step in. With what money? Federal debt is $36 trillion. Interest payments are $1 trillion annually. There's no fiscal space for trillion-dollar bank bailouts, and politically it's toxic. 2008 bailouts created the Tea Party. The next bailout would create something worse. Politicians know this. They'll let banks fail rather than face voter rage. Objection 4. This is fear-mongering. Is it fear-mongering to read FDIC data? Is it fear-mongering to point out $684 billion in unrealized losses? Is it fear-mongering to note that $570 billion in commercial real estate debt matures in 2026? These are facts, published by regulators. The fear-mongering is pretending everything is fine. The historical pattern. Every banking crisis follows the same pattern: expansion, excess, exposure, explosion. We're in the exposure phase right now. The expansion was 2010 to 2021. Zero interest rates, endless Fed support. Banks loaded up on low-yield assets. The excess was 2020 to 2022. Everyone believed rates would stay low forever. Banks stopped hedging interest rate risk. They assumed the Fed would never raise rates meaningfully. They were wrong. The exposure is now. $684 billion in unrealized losses exposed, $2.8 trillion in commercial real estate exposure, $9.2 trillion in uninsured deposits exposed. The explosion comes next. Nobody knows the exact trigger. Maybe it's a major bank downgrade. Maybe it's a large corporate default. Maybe it's a sovereign debt crisis in Europe that spreads here. The trigger doesn't matter. The fuel is already stacked. The kindling is dry. Something will light the match. In 1929, it was margin calls. In 2008, it was Lehman. In 2026, it will be something. And historians will look back and say it was obvious, because it always is, in hindsight.
What you must do now. 6 steps to protect yourself before the crisis hits. Step 1. Verify your FDIC coverage. Every account at every institution is separately insured up to $250,000, not per person, per account type, per institution. If you have $500,000 in one bank, $250,000 is at risk. Split it into 2 banks. Now it's fully covered. This is basic protection. Do it today. Step 2. Avoid regional banks with high commercial real estate exposure. The FDIC publishes this data. Banks with CRE loans above 300% of capital are vulnerable. Over 900 banks meet this threshold. If your bank is one of them, move your money. Inconvenient? Yes. Better than losing it? Absolutely. Step 3. Keep minimum balances. Don't keep excess cash in banks. Banks are for liquidity, not wealth storage. Keep 3 to 6 months of expenses accessible. Everything else should be invested elsewhere. Treasuries, money market funds, hard assets, anything but a deposit account with exposure. Step 4. Diversify across institution types. Don't just use banks. Use credit unions. Use Treasury Direct for government bonds. Use brokerage accounts with SIPC protection. Spread risk across different regulatory frameworks. No single point of failure. Step 5. Watch the warning signs. Monitor bank stock prices. When regional bank stocks crater, deposits flee. Watch credit default swaps on major banks. When CDS spreads widen, the market smells trouble. Follow FDIC problem bank lists. When the number jumps, the crisis is accelerating. These are your early warning systems. Step 6. Have physical cash reserves. If the banking system freezes, ATMs go dark. Credit cards stop working. Digital payments fail. Cash is king in a crisis. Keep $2,000 to $5,000 in physical cash at home. Small bills, 20s and 50s, hidden securely. It's old-fashioned. It works.
The choice you face. Right now, you have two options. Option 1, believe the experts. Believe Jerome Powell when he says the system is resilient. Believe Janet Yellen when she says your deposits are safe. Believe CNBC when they say soft landing. Hope they're right. Option 2, believe the data. $684 billion in unrealized losses, $570 billion in maturing commercial real estate debt in 2026, $9.2 trillion in uninsured deposits, 900-plus banks with dangerous CRE exposure. Prepare accordingly. The experts have a track record. They missed 2008. They missed 2023. They'll miss 2026. The data doesn't lie. The data doesn't have an agenda. The data just is. The reality nobody wants to admit. The American banking system is built on confidence, not capital, not reserves, confidence. The moment people stop believing their money is safe, the system breaks. And right now, the foundation of that confidence is cracking. Every unrealized loss is a crack. Every commercial real estate default is a crack. Every deposit withdrawal is a crack. Eventually, the cracks connect. When they do, the collapse is sudden. In 2023, Silicon Valley Bank went from stable to dead in 48 hours. The next crisis will be faster, because now people know it can happen. They're primed to panic. They're watching for signs, and when they see them, they'll move. Not in weeks, not in days, in hours. Your protection window is now, not after the headlines, not after the panic, now, while you still can. The bottom line. 2026 isn't just another year. It's the year the bill comes due for 15 years of zero interest rates. It's the year banks have to refinance at double the cost. It's the year unrealized losses become realized losses. It's the year the commercial real estate market breaks. And it's the year your deposits are most at risk. The question isn't whether this happens. The math says it happens. The question is whether you'll be prepared, whether you'll have taken the 6 steps, whether you'll have protected what's yours, or whether you'll be standing in line at a closed bank, watching your life savings disappear, like millions did in 1929, like thousands did in 2008, like depositors at Silicon Valley Bank did in 2023. History doesn't repeat, but it rhymes. And right now, it's rhyming with every banking crisis that came before. Subscribe for Part 2, where I break down exactly which banks are most at risk, the specific institutions to avoid, the safe havens that will survive, and the assets that will protect your wealth when the banking system breaks. Because by the time the news confirms what I'm telling you, it's already too late. The prepared survive. The unprepared become a statistic. Which one will you be?